Hello, welcome to Capital Sensei. Today, we're going to dive deep into one of the most influential investment books ever written, Common Stocks and Uncommon Profits by the legendary Philip Fisher. We'll break down his timeless philosophy, explore his famous 15-point checklist for finding great companies, unpack his Scuttlebutt research method, and understand his surprisingly simple, yet profoundly difficult, rules for when to buy and when to sell. We do our best to answer questions here. So if something sparks your curiosity, or if you have a story about your own investment journey, please share it in the comments below. Your questions and experiences help everyone learn, and that's how we build a strong community of savvy investors together. So, who was this Philip Fisher? If you've heard of Warren Buffett, you've indirectly been influenced by Fisher. Buffett himself said he is 85% Benjamin Graham and 15% Philip Fisher. And that 15% is a hugely important piece of the puzzle. Fisher was a pioneer of what we now call growth investing. He started his firm, Fisher & Company, way back in 1931, right in the thick of the Great Depression, and ran it for over 60 years, generating incredible returns for his clients. Now, to really get what Fisher was about, it helps to contrast him with his famous contemporary, Benjamin Graham, the father of value investing. Graham was like a bargain hunter at a flea market. He was looking for cigar butts, companies that were statistically cheap, trading for less than their liquidation value. You could pick one up, get one last free puff, and then toss it. It was a quantitative game. Fisher, on the other hand, was playing a completely different sport. He wasn't looking for cheap cigar butts. He was looking for the equivalent of a 5-star restaurant that you could own a piece of for the rest of your life. He was a qualitative investor. He believed the real money, the uncommon profits, came from identifying truly outstanding companies and holding them for the very, very long term. At the heart of Fisher's philosophy is this idea: it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This might sound simple, but it's a revolutionary thought for many people. It shifts the focus from what is this stock's price to what is this business's quality. Fisher was obsessed with finding businesses that could grow their sales and profits at a much faster rate than the overall economy for many years, even decades. He wasn't trying to time the market. He was trying to identify businesses with such powerful, durable competitive advantages that market fluctuations became almost irrelevant over the long haul. So, how did he find these incredible companies? This brings us to one of his most famous concepts, the Scuttlebutt method. The name sounds a bit like old-fashioned gossip, and that's not far from the truth. Fisher believed that you couldn't learn everything you needed to know about a company just by reading its annual report or listening to the chief executive officer on a conference call. That's the official story, the polished version. The Scuttlebutt method is about getting the unofficial story. It's investigative journalism applied to investing. Imagine you were thinking about buying a local coffee shop. You wouldn't just look at their accounting books. You'd go there on a Monday morning and a Saturday afternoon. You'd talk to the customers. Are they happy? Do they love the coffee? You'd talk to the employees. Are they treated well? Do they respect the manager? You might even try to chat with their suppliers who deliver the coffee beans and the milk. Do they get paid on time? Is the shop easy to deal with? You'd even check out the competing coffee shops down the street. What do they think of their rival? This is Scuttlebutt. It's about building a 360-degree view of the business by talking to everyone connected to it. It's hard work, but it gives you an information edge that you can't get from a stock screener. This investigative work was the foundation for Fisher's legendary 15-point checklist. This checklist is his framework for systematically identifying those truly wonderful companies. It's not a simple yes or no list. It's a series of deep, probing questions. Let's break them down. grouping them into a few key themes. The first theme is all about future growth and industry dominance. Point 1 asks, does the company have products or services with sufficient market potential to make possible a sizable increase in sales for at least several years? Fisher wasn't interested in a company that had a great year. He wanted a company that could have a great decade. He looked for companies in large and growing markets, or companies that were so innovative they were creating new markets entirely. Think about the early days of a company like Amazon, moving from just selling books to becoming the everything store. That's the kind of long-term runway Fisher was looking for. This leads directly into point 2. Does the management have a determination to continue to develop products or processes that will still further increase total sales potentials when the growth potentials of currently attractive product lines have largely been exploited? This is the anti-complacency point. A great company is never satisfied. The moment one product line matures, they're already deep into developing the next one. Think of Apple. The iPod was a massive success, but they didn't just rest on that. They were already working on the iPhone, which completely changed the game. Then came the iPad, the Apple Watch, and their massive high-margin services business. That's the relentless innovation Fisher wanted to see. Point 8 reinforces this. Does the company have a leading position in its industry? Being the leader or one of the leaders brings immense advantages. You often get better pricing power, stronger brand recognition, which lowers customer acquisition costs, and you attract the best talent. It creates a virtuous cycle. It's much easier to defend the castle than it is to storm the walls. Fisher wanted to own the castle. And finally, in this group is point 13, which is a bit more technical but crucial. In the foreseeable future, will the growth of the company require sufficient equity financing so that the larger number of shares then outstanding will largely cancel the existing stockholders' benefit from this anticipated growth? Let me translate. Will the company have to keep selling off little pieces of itself to new shareholders in order to fund its growth? If they do, it's like constantly adding more water to your soda. Your drink gets bigger, but your flavor gets weaker. Your ownership stake is diluted. The best companies are like a fountain, funding their own growth from the cash they generate internally. The next major theme of the 15 points revolves around profitability and competitive advantages, what Warren Buffett would later call the moat. Point 3 asks, how effective are the company's research and development efforts in relation to its size? Notice the word effective. Fisher didn't just care about how much a company spent on research and development. He cared about what they got for that spending. It's not about how much flour you buy for your bakery. It's about how many delicious, profitable cakes you actually sell. A company can pour billions into R&D and have nothing to show for it. Fisher wanted to see a clear link between R&D spending and new, profitable products hitting the market. Then comes point 4. Does the company have an above-average sales organization? This is so often overlooked by investors who get mesmerized by technology. You can invent the greatest widget in the world, but if you can't market it, sell it, and distribute it effectively, you don't have a business. Fisher understood that sales and marketing weren't just costs. They were essential engines of growth. A world-class product needs a world-class sales team to reach its full potential. Of course, sales are pointless without profits. Point 5 gets right to it. Does the company have a worthwhile profit margin? A company can have massive revenues, but be losing money on every sale. That's a recipe for disaster. Fisher wanted to see healthy, robust profit margins. This indicates that customers are willing to pay a premium for the company's product or service. and that management runs a tight, efficient operation. High margins provide a cushion during tough times and fuel for growth during good times. And it's not enough just to have good margins now. Point 6 follows up with, what is the company doing to maintain or improve profit margins? This is another check on complacency. Are competitors starting to eat away at their pricing power? Are costs creeping up? A great management team is always paranoid about this. They are constantly looking for ways to become more efficient, to innovate, and to strengthen their brand so they can protect and even expand those precious margins over time. The final, and perhaps most important, group of points is all about people, management, and culture. Fisher was adamant that a company is only as good as the people running it. This is where the Scuttlebutt method really shines, because you can't assess these things from a spreadsheet. Point 7 asks, does the company have outstanding labor and personnel relations? Happy employees are productive employees. Companies with high employee turnover have a hidden and massive cost. It's a giant red flag that often signals a toxic culture or poor management, which will eventually show up in the financial results. Point 9 looks at the top. Does the company have depth to its management? Fisher was wary of the one-man show. What happens if the brilliant, visionary chief executive officer retires, or worse, gets hit by a bus? Is there a deep bench of talented people ready to step up and continue the mission without missing a beat? A great organization develops leaders at all levels. It's not dependent on a single superstar. Then we go into the nitty-gritty of how management operates with point 10. How good are the company's cost analysis and accounting controls? This sounds boring, but it's the nervous system of the business. Does management truly understand the details of their own company? Do they know precisely which products are making money and which are losing it? Without tight controls, a company is flying blind, and it's only a matter of time before they fly into a mountain. Point 11 is an interesting one, a sort of catch-all for unique advantages. Are there other aspects of the business, somewhat peculiar to the industry involved, which will give the investor important clues as to how outstanding the company may be in relation to its competition? This is where deep industry knowledge pays off. For a software company, it might be the network effect, where the product becomes more valuable as more people use it. For a railroad, it might be the irreplaceable right-of-way for their tracks. This point forces you to think beyond generic metrics and find the unique secret sauce of the business. Point 12 gets to the heart of a manager's mindset. Does the company have a short-range or long-range outlook in regard to profits? Fisher despised managers who would cut R&D or marketing budgets just to make their numbers look good for the next quarter. This is like eating your seed corn. You get a little more food today, but you'll starve tomorrow. He wanted to invest with managers who acted like true owners, making decisions that would benefit the company 5 or 10 years down the road, even if it caused some short-term pain. And the final 2 points are all about integrity, the absolute bedrock of a Fisher-style investment. Point 14 asks, does the management talk freely to investors about its affairs when things are going well, but clam up when troubles and disappointments occur? Think about that. We all have friends who are happy to share their successes, but go silent when things get tough. You can't really trust them, can you? Great management is transparent. They are upfront about challenges and mistakes because they are confident in their ability to overcome them. If a management team only ever tells you good news, you should be very, very suspicious about what they're not telling you. Which brings us to the grand finale. Point 15. Does the company have a management of unquestionable integrity? This is the ultimate pass-fail test. If the answer to this question is anything but a resounding yes, then none of the other 14 points matter. If you can't trust the people at the helm to be honest with you, to be good stewards of your capital, and to act in the best interests of all shareholders, then you shouldn't even consider investing. It's the foundation upon which everything else is built. So after all that exhaustive work, after you've used the Scuttlebutt method to answer those 15 questions, and you finally found one of these rare, wonderful companies, the next question is obvious. When you buy it? Fisher's answer was refreshingly straightforward. He wasn't a market timer. He believed that trying to perfectly time the highs and lows of the stock market was a fool's errand. His view was that if you found a truly great company that meets his criteria, the best time to buy is when you have the money. Don't get too cute trying to wait for a 5 or 10% dip, because you might miss a 50% run-up while you're waiting. That being said, he did acknowledge that the best opportunities often arise during times of widespread fear, when the overall market is panicking, or when a great company hits a temporary, solvable rough patch that scares away less informed investors. That's when you can get a wonderful business at a particularly attractive price. But the key is that the decision is driven by the quality of the business first and the price second. Now for the really radical part of Fisher's philosophy: when to sell. In a world of constant trading and what have you done for me lately, Fisher's advice is almost shocking. He argued that if you have done your homework correctly and bought a truly outstanding company, the best time to sell is almost never. He famously said, if the job has been correctly done when a stock is purchased, the time to sell it is almost never. This is because the magic of long-term compounding is so powerful that selling a great business is often a huge mistake. He provided only 3 valid reasons to ever sell a stock. First, you realize you made a mistake in your initial analysis. The company wasn't as great as you thought it was. Perhaps its management wasn't as strong, or its competitive advantages weren't as durable. This requires a great deal of humility to admit you were wrong and move on. The second reason is that the company has fundamentally changed and no longer meets the 15-point criteria. Maybe a fantastic management team retires and is replaced by a mediocre one that destroys the company culture. Or maybe a new technology comes along and completely disrupts their business model, eroding their competitive moat. The key here is that the business itself has deteriorated, not just that its stock price has gone down. The third and final reason to sell is a rare one. You have found a demonstrably superior investment opportunity. Even then, Fisher was extremely hesitant. You have to be absolutely certain that the new company is not just a little better, but significantly better, to justify the capital gains taxes you'll have to pay on the sale, and more importantly, the risk that your analysis of the new company is wrong. His philosophy is one of extreme patience and concentration. It's about finding a few great companies and holding on for the ride. It's about treating your investments like a marriage, not a series of one-night stands. So, what are the big takeaways from Common Stocks and Uncommon Profits? First, it's a call to think like a business owner, not a stock trader. Your goal is not to predict the wiggles of a stock chart, but to understand the long-term competitive dynamics of a business. Second, it emphasizes that quality, especially the quality of management and culture, is paramount. These are the soft, qualitative factors that create hard, quantitative results over the long run. And third, it teaches us that successful investing is not easy. The Scuttlebutt method requires real work, real diligence, and real critical thinking. It's a complete rejection of get-rich-quick schemes. It's a philosophy built on patience, discipline, and the conviction to hold on to your winners through thick and thin, allowing the power of compounding to work its incredible magic. Philip Fisher provided a roadmap, not for finding the next hot tip, but for identifying businesses built to last. Businesses capable of generating wealth for decades. The work is demanding, but as the title of his book promises, the potential rewards are truly uncommon.